The stock market is priced for perfection, but so many things could go wrong. This video will go over the reasons why 2025 may be the year that the everything bubble pops. The stock market has benefited from a perfect alignment of favorable factors. Massive monetary and fiscal stimulus during the COVID pandemic injected unprecedented amounts of liquidity into the financial markets in a short space of time. Even after the pandemic ended, the government's budget deficits have continued to be unusually large and have played a major role in making the economy grow rapidly. GDP growth has been well above what's considered to be its potential sustainable growth rate. The inflation rate has declined sharply, fueling expectations of large reductions in the federal funds rate. The outlook for lower interest rates has driven the stock market higher. Large current account deficits have produced large capital inflows into the U.S., which have helped push asset prices up and hold interest rates down. Surging immigration has added to the workforce, held down wages and inflation, and pushed up consumer demand. The Infrastructure Act, the CHIPS and Science Act, and the Inflation Reduction Act, passed by the 117th Congress, have spurred huge investments in the economy. AI mania has added trillions of dollars to equity valuations. Finally, wealth has surged by a mind-boggling $52 trillion, 44%, during the last 5 years. This explosion of wealth has supported economic growth, and economic growth has supported the surge in wealth. During the months ahead, however, many of these forces that have driven economic growth and pushed asset prices higher could end or be reversed. If they are, many trillions of dollars of wealth could be wiped out through a very painful stock market crash. This danger is amplified by the fact that stock valuations are significantly higher than historical averages, making them particularly vulnerable to any disappointments or shocks. This video will review all these risks. At the top of the list of things to worry about is the possibility that inflation will reaccelerate. The inflation rate has fallen from 9% in mid-2022 to less than 3% now. And until recently, inflation was expected to continue falling back toward the Fed's 2% inflation target. In response to slowing inflation, the Fed began cutting interest rates in September and has lowered the federal funds rate by 100 basis points since then. Up until last month, the Fed had expected to continue cutting rates significantly further in 2025 and 2026. At its FOMC meeting in September, the Fed indicated that it would probably reduce the federal funds rate by a further 100 basis points in 2025 and by 50 basis points more in 2026. The Fed's economic projections then showed the federal funds rate falling to 2.9% by the end of 2026. That would have been nearly 150 basis points below where it ended 2024. Investors were thrilled at the prospect of significantly lower interest rates, and stock prices